Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The FOMC decision is out and markets have largely remained unchanged, but there is always something market participants try to assess. Just like always, Powell's answers during press conference was ambiguous and provided no hint regarding the timeline of future rate cuts, but that was until he went off script and spoke about markets' expectation of rate cut in March. Good morning, JK. Our listeners want a FOMC debrief. What's your take on yesterday's moves?
Hey, good morning, Swaraj. Yes, it was a very, very interesting event. Yes, no change in the rates, obviously, as expected, but all attention was on the FOMC statement and also on what Powell was going to say. There will be many interpretations of overall statement by the Fed and Powell, but as you said, what stood out and ultimately directed the market was his almost categorical statement that there would be no rate cut in March. In fact, there were no hints at all about when they would start dialing back the rates, except a clear statement that a peak in rates had been seen. So this is a departure from earlier statement. Overall, Powell did say that they need more time to gain confidence in the inflation slowing down, and also an obvious effort to disengage the market's aggressive pricing of rate cuts. And so obviously he was looking at the overall strong growth picture and the better balanced jobs market. In considering any adjustments to the target range for the Fed funds rate, what the FOMC statement said also was that the committee will carefully assess incoming data, evolving outlook, and the balance of risk. Now, some people might have been disappointed, but overall, if you look at it, this is not a big surprise or a shock that the market has to be looking at because there were already doubts that the March rate cut would not happen, and he only reconfirmed the same thing. And even earlier also, there was no confirmation as to when they would start cutting rates. So now, Fed, of course, he also said that Fed will get into detailed discussions on QT, reducing and all those things. So, but if you look at the market reaction, notwithstanding whatever he said, bond yields which had been already slumping ahead of the FOMC, reacting to ADP payrolls that came weaker and also the lower employment cost index, they tried to recover after FOMC, but again they fell back to lower levels. Now, rate cut expectations in March have been seesawing whole session, and now they are standing again above 52% in March, despite an extremely neutral stance, as you can read, Fed and the Powell. Now, market has actually added, according to estimates, 16 basis points of cuts to this year, and overall, in the next 1 year, market is expecting 2.5% of rate cut. So the market's broader view of rate cuts by Fed has not changed. It's not. It's only a question of whether it's going to start in March or May. Obviously, Fed is not taking chances with inflation, and that's the reason why they are playing the cautious card. And that's the reason why market is not stopping buying bonds, and that's very much reflected in the yields. 10-year yield was down 13 basis points yesterday, and even 2-year was down more than 15 basis points. So the story is it's not much, but there is a confirmation that they're ready to cut and aggressively if needed. And whether it is March or May, it's neither here nor there. On the stocks, it was a markedly terrible day for the major indices in the US. I mean, compared to the recent strong performances. Now, apart from Powell's disappointment with his statement, as read by some, that contained no dovishness, markets were hit by two important factors. One was the disappointing earnings from mega cap tech stocks, and the other was, one of the regional banks' share falling 46% after they, reduced the quarterly dividend by 70% to just 5 cents per share. And they also reported a much lower, actually they reported a loss of 185 million compared to 274 million year earlier. So some people read it as, another event of banking sector failure, etc. But that was just taking things too far. And eventually, I think most people are seeing it as a one-off and not seeing it as a series of such events that is likely. And markets, of course, have been buying bonds, and stocks were down, I think, more due to the tech mega cap tech stocks falling, and also some amount of lower jobs growth, and also lower inflation number, ahead of non-farm payroll number, which is coming on Friday. I think markets are taking profit also on the big rise in the stocks. Now, despite the heavy losses on in yesterday's session, S&P 500 has had a third straight monthly advance. So now, on the currencies, if you look at it, euro has stayed within the range that was established even one day before. It fell after Powell statement. It rose before that. After the ECI and the ADP numbers came. In fact, there was also a focus on the German numbers, retail sales as well as the inflation, the latter being more important. Inflation on the headline was lower, but it had a lot of base effect, and therefore the market really did not read much into it. And there was no change in the expectation on ECB rate cut timing, which still stands more near June. But it's still evolving, and I think today's Eurozone inflation number would be more crucial. Now, GBP is obviously waiting for the rate decision. Rather, no change in rate expected, but what the Bank of England would say about as a forward guidance is what the market is looking at. So GBP is holding in a much tighter range. Yen has been more volatile, which was almost at 148 early in the day, fell to as low as 146.06. When reacting to lower yields in the US, that's not really budging. So that actually is keeping the dollar yen on the lower side. In fact, as per the minutes or summary of opinions that was at the last BOJ meeting that was published yesterday, policymakers discussed in January the likelihood of a near-term exit from negative interest rates. So that also helped again to recover. But overall, if you look at it, dollar did not really move much even against the emerging market currencies. They are holding on to their own. Now, come to the rupee. We have been saying for several days that rupee has been immune to moves in either the dollar index or EM currencies, nor reacted to the big volatility in local equities. Yesterday was no different, and the currency showed mild strength on the back of reported month-end flows. Now, it has consistently diverged from the DXY, even as it closed the month of January with a gain of 0.2%, while dollar index actually closed 2% higher. Now, despite recent outflows, INR did not breach 83.20, and that has kept the sellers interested. Now, what's ahead is, apart from FOMC outcome and the resultant dollar move overnight, which is also not so significant, we have the interim budget of the government due to be presented today, and it's very likely that it will contain, it is very unlikely that it will contain any major proposals, and more so anything that could influence the rupee. However, the government's fiscal path will be important for the medium-term direction of the Indian macros, and lower deficit projection will be positive for the bond market, where expected index-related flows may well start to be discounted by the players. Now, just to get a hint, fiscal deficit of the annual target is just 55% of till December. That's quite a strong, positive news. Also, the net tax revenues for April-December period is about 74.2% of the annual estimate. And on the back of robust collections, the ratio of direct taxes to GDP, this financial year is likely to be the highest in this century so far. So there is a good news on the fiscal. We have had good news on the trade also, deficit coming down. So overall macros, and of course the growth picture, we all know that 7% is the projection by RBI, by the government, and RBI is projecting similarly, while IMF also projected higher growth for India in 2024. Overall, I don't see much challenges for the rupee to weaken, and I see subject to what RBI does, a path for rupee strength is higher than for a weak rupee. Of course, we will look at the details of the interim budget as well as the non-farm payrolls ahead. I'm just ending this with an interesting event that Brazilian central bank cut interest rate by 0.5% yesterday. That's the fifth time in 7 months, from 13.75 to 11.25%. This is on the back of falling inflation. And Brazil central bank has been one of the more proactive central banks. They had acted promptly in hiking rates also after the COVID, and the rates had gone up from 2% to as high as 13.75% between early 2021 and late 2022. It's the other side of the global economy where interest rates are moving massively. Just for your information. Thank you.
Thank you, JK. And quickly summarizing FOMC, it was a neutral stance by the Fed, and of course, Powell pushed back against markets' expectation of a rate cut in March, but he did confirm that the peak rates are in. When it comes to market reaction, currencies remain range bound. Bond yields slump further towards the lower levels, and of course, markets are expecting a 2.5% rate cut by Fed this year. Uh, Today, we have the Eurozone inflation number, which will be important. Apart from that, we also have the Bank of England rate decision, which is again important for pound watchers. And for rupee, we saw mild strength on the back of month-end flows. And for India, we have an important event, which is the interim budget, which is going to be presented. Since it's a pre-election budget, we might not see any major announcement, but there can be some sort of fiscal consolidation possible. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.